Welcome, and thank you for joining us for this unique presentation of Rochester Area Community Foundation's annual investment briefing with Mike Miller and Crewcial Partners. I'm Mary Hartstein, Director of Philanthropic Engagement and Impact, and I'm happy to introduce Mike to you today. Mike is the founder and Chief Investment Officer of Crewcial Partners. Mike provides the Community Foundation by way of our staff and investment committee with advice on asset allocation, manager selection, and performance evaluation. Mike has over 40 years of experience in the consulting business, all with Crewcial Partners, and a 20-year relationship with the Community Foundation. Crewcial Partners is a New York-based firm which focuses on providing consulting services to nonprofit institutions and specializes in foundations and endowments, overseeing approximately 120 client relationships, representing over $30 billion in capital. Thank you, Mike, for creating this special presentation to make this much sought-after investment briefing accessible to all of our fund holders and partners. Mike?
Thank you, Mary. It's a pleasure to be here with everyone during this very difficult period in the markets. I was thinking back to some of the presentations we've done in the past and all the other times that we've been in difficult times, and thought that it would be very interesting to start with a retrospective on some of those times over the last 20 plus years. So we have a slide up on the screen which shows you actually 7 different periods where the portfolio, the blended endowment, has dropped at least 10%. The earliest one was actually just about 20 years ago in 2001, all the way through the one that we're in right now. If you look at the second column, you'll see the size of those drawdowns, which puts the current one at negative 20.4% in some perspective. It's not the worst and not the best we've ever had, but it's very much along the lines of everything we've seen before. There's a third column, or a second numerical column, which shows you how we've done compared to the stock market. And you can see in all but one of those periods, the portfolios outperformed the stock market during these times. And that's where our diversification and the strategy we use is really, really important, which we will talk about today. The fourth column gives you a sense of how long it took to catch up to where you had started. And that's a really important point. I think what happens in difficult markets is people begin to feel a sense of a fatalism about them, like it's going to last forever and it's going to be terrible, it's going to be awful. And it is awful while it's happening, but it changes, and it changes quite suddenly and without warning. And that leads us to that fourth column, which shows you that these returns have come back. The losses, i.e., were made up very quickly. You can see the worst case scenario was only 20 months, and that was after we had a 36% decline. So that's a huge gain that had to occur. It happened in 20 months, and I can assure you, at the end of February 2009, we were staring at a 36% decline. We would not have guessed that we would have had it all back and then some in 20 months. And so that's a really important point. You'll see the last one before the one we're in now was during COVID, and even that recovery occurred over just 8 months. So now, of course, we have not applicable yet because we haven't recovered the 2022 losses quite at this moment. And we're not going to make a prediction as to how long it will take, but history tells us it'll happen sooner than anybody might guess. And then last but not least on this page, it's also worth noting that when you do investing the right way and you're very disciplined and patient, which is what I will spend some time talking about today with you, these losses are really, truly a distant memory at some point in time. And so the last column gives you a really interesting retrospective about what happened 5 years from the peak. So in other words, not at the bottom of these declines, but the start of them. And you can see that the Community Foundation portfolio has generated 3 to 6% per year, depending on which period we look at, 5 years post the peak, And that's really important, because it says, even if you have the worst possible starting point, we still generated a pretty meaningful positive return. Those positive returns are not what we seek to generate over time. To be clear, they're lower, but we're picking the worst possible starting moment, which is why they're a little lower. And then given more time, they come back even more strongly. Now you can see we still have some not applicables. We do not have 5 years since the peak in 2018 or 2020 or of course 2022. So this is a page that I think really hopes us all gain some perspective about what we're going through right now. And I'll talk now about a little bit more about the results the foundation has generated over time. So now this is through September 30th of 2022. The returns today are actually much better, but we're not going to quote intra-quarter periods. But nevertheless, the recovery has started, which is nice to see. But the portfolio here you can see is down 17.5% per year for the year, which is better than the benchmark, which is 70% global stocks, 30% bonds. We have hung around the benchmark over 5 years with a little bit of a shortfall, but then over 10, 20 years and since 1990, this portfolio has generated meaningful premiums, particularly over those longer periods compared to that benchmark. Very importantly, The goal of the blended endowment is to achieve CPI plus 5% over very long periods of time. And as we'll talk about today, inflation is a major issue in our economy and our world today, and that has created a lot of problems for the portfolio and capital markets in general over this last year. And you can see this gigantic shortfall where we're down 17.5, which is much better, is a little bit better than the markets, but we're way behind CPI plus 5, which is up 13.7%. And you can see the way that filters through to the longer periods where we're now behind for 10 years, up 5.7 per year versus up 7.8 for that goal. But then you get to 20 years and we're just a little bit behind. And then 1990, you can see we're ahead. And I think one of the critical things I want to leave with today is that the skill of the foundation as an asset allocator and an investor really matters most when you look at that 1990 period, up 8.2% per year compared to the 7.8 we were trying to achieve to preserve the purchasing power of these assets. But the benchmark was only up 7. So we would have fallen short if it wasn't for the skill of the foundation's investment committee and its overall governance structure. So this is something that's just really important, which is why we spend so much time and energy at the committee level and at Crewcial trying to make sure we continue to repeat these results. And we're starting to see that happen, as you can see in the last year, in a losing cause, but that will change, as we'll talk about in a minute. Now the next slide. So one of the challenges when you look at performance figures, as I just referred to a minute ago, is that you're always looking at a moment in time. And so whatever the capital markets are doing at that moment in time is what you see. And it has an inordinate impact, particularly during very volatile periods, on even the longer term numbers. So we thought it'd be really interesting to show you what the foundation's returns look like just 1 year ago. And you can see these gigantic positive numbers, up 23.9% for the year, and across the board, basically returns that were solidly in the 8, 9, 10% range, which is exactly where we expected to be over time. They were also nicely ahead of CPI plus 5 over all these periods of time, which is why we really don't get too frustrated or worried about a short-term period where we're struggling, because we know long-term, good, solid investment decisions really make a big difference, and that's what we're really focused on here. Next slide shows you a really important second way to think about perspective around this issue. So each of these bars these are the same returns through September of 2022, to be clear, not 2021 anymore, for the foundation compared to the 70-30 benchmark, which is the red bar, and CPI plus 5, which is the green bar. And here, a couple things that start off. Well, the first is, if you went back to one of the earlier slides, which we won't do now, you can see that the foundation had a premium to its 60-40 benchmark, to 70-30 benchmark, excuse me. And that premium looked like it was a solid number, 1.2% difference. But look at those bars on the right-hand side of the screen. It's a massive difference when you compound this out over time. So these returns are cumulative. The ones you looked at before are annualized or per year. And cumulative is actually what we care most about, which is why we don't worry about short-term underperformance. We just need long-term outperformance, because that compounding impact is massively important. And you can also see on this chart how much it has mattered to achieve the premium return to CPI plus 5. It's given us a big cushion, which is making a big difference right now. And the shortfalls you see over the shorter periods can then be more easily picked up, basically. So I want to step back and talk about how we've had this success at the foundation. And it starts with governance and decision making. So the investment committee meets 4 times a year minimum. They've been meeting more often recently, not because of the markets, but because we're building a really interesting dynamic portfolio that includes some private equity. And you can see here, though, that the foundation's investment committee makes decisions around asset allocation strategy and which managers and index funds we should use in the portfolio. So the one line leads to the investment managers. They're the ones who actually pick the stocks and bonds that the portfolio owns. The committee does not do that. Crewcial Partners is on the left. We work for the foundation and advise the committee, as Mary pointed out, about asset mix and manager selection. So this is the team essentially working on behalf of the foundation at all times. The next thing I want to talk about is the strategy that we're utilizing. And I think the critical element about it is it's not intended to be one that requires that we be geniuses. Because genius is a wonderful thing, but genius is not necessarily a repeatable thing, particularly over decades and decades, as the foundation's success has evidenced. So we think about foundation strategy from a very simple perspective. Point 1, we establish a mix which is expected to achieve long-term objectives. When things get tough like they are right now, we do not change the portfolio in reaction to them. We do not sit down and say, well, we think the market's going to be down this year, or maybe it'll be down next year. And the reason we don't do that is because we don't actually think anybody knows what's going to happen. Surprise is one of the great things about life and sometimes, and certainly about markets. And so we assume and expect that we will not know what's going to happen. and that's why we avoid making predictions. But we do think about risk, because a lot of times when people are making predictions, they're trying to protect themselves. And the other way to protect yourself as a long-term investor is to be diversified. And that's what you see at this last bullet point. So you think long-term, you don't get sucked into the idea of trying to guess what's going to happen, and you stay diversified. These are critical elements to a multi-decade record of success. So the foundation has, for years, had a 70-30 mix. That was in place for 23 years. We're almost to 10 years, actually. About 9 years ago, the board here approved the change from 70% equities to 20%, staying at 70% equities, but changing that 30% fixed to be 20% in fixed income and 10% in alternatives. Interestingly, this was at the time, I remember every presentation we made about this, we talked about the fact that it was not done because we knew what the bond market was going to do in the short term. But it was done because interest rates were very low, even back in 2013, and we did not like the fact that they could not contribute meaningfully to the returns of the portfolio, again, over those long periods of time that we're so focused on. So this change, it's taken 9 years, it's working magnificently now as the bond market is finally adjusting to this, and it's been a great outcome for the foundation. It was a very well thought out approach, and it's been extremely effective. So the next part is I wanted to spend a minute on, just briefly, is how we think about hiring the managers in the portfolio. There are 4 simple rules that we teach the analysts at Crewcial and that the committee also applies when they think about picking these managers. Rule 1, returns are always accompanied by risk. There is no getting around the fact that if you want to generate a good return, you're going to have to take a risk. And the question isn't whether you're taking a risk or not, it's understanding the risk you're taking and then deciding whether or not you can live with it or not, especially if it happens to actually manifest itself as reality. So we think a lot about the risks we take, and that's what the committee is very focused on. The second point, which we need to understand the strategy, we need to know the key people, we need to avoid needless complexity. We do not like things that require a long time to explain because they're probably too hard, and if they're too hard, we will not know what they're doing and why they're doing it, which is a huge problem for us. The third point, we do not take risk around operations. This is, we used to call it the Bernie Madoff problem. We'll maybe come up with another term someday for it. But basically, this is you must have an independent custodian, a credible auditor, and an outside administrator. And that's because we need to make sure that foundation's assets, the only risk they're taking is investment risk, not operational risk. And last but not least, this is a forward-looking process. One of the reasons that most people have a really hard time successfully beating their benchmarks and using active management effectively is because they're always looking backwards. A manager has a track record. If it looks good, we think they're good. If it looks bad, we think they're bad. And the reality is it's cyclical. And when you have a confident, experienced group of people like this investment committee and like Crewcial, we can tell the difference. We know who's doing a good job and who's not. Track records is an afterthought, although we obviously expect good track records over time. So we also need to think about living in a complex world, which is where I want to go next. And complexity demands that we have a robust risk framework. So we are willing to take risks, but we need to understand those risks, and then we need to get paid for them. And that's the first bullet point we have up here is so important, which is that second line, variant perception. If you or I agree on everything, then we do not have a variant perception. If everyone's in alignment on something, then that's just a fact and it's in the price of a security. If, on the other hand, one of us has a very different view, and by the way, particularly if it proves to be accurate than everyone else, that's immensely valuable for an investor. And that's what we're looking for. And one of the reasons and one of the ways we get to that is to focus on a number of different things. The key point being that talent is the driving force, and we should look as far and wide as we can to find that talent, because with differences in age, with differences in geography, i.e. where do you sit, differences in gender and ethnicity, these create different perspectives on the world, different life experiences, and those by definition for well-trained, talented people generate variant perceptions. So that is the core of this idea of how we diversify this portfolio on a lot of different levels. And by the way, it's going to be the secret to how this portfolio thrives in a much more complicated economic and macroeconomic situation we're in now. And last but not least, many of you come into the term ESG, which stands for environmental, social, and governance risk. This is also, by the way, it's confused as values-aligned investing and screening and a lot of other things. And it means all those things to different people. But what it really means is it's a risk assessment tool. And that's something that can also be used to add to returns. And we think it's extremely important to stay focused on those things. So I'm going to switch gears because I kept referring earlier to a more complicated climate. And this is the kind of a climate, by the way, that the portfolio thrives in. And so we're not excited that people are having a hard time. We're not excited to see people's asset values dropping. Those are terrible things. But we are excited about the changes that are going on. So let me take you through some of them. So the first thing is this title, long-term versus short-term anxiety. One of the concerns we have is that everybody's got the latter and not enough of the former. There's a lot of things changing out there, and these things have very long-term implications for capital markets, and we're afraid that people don't quite see that. And that's because they've been trained to think that things just come back very quickly, which they don't always do. So first point, we now have inflation. I don't need to tell anyone in this room that we have rising inflation. It's here. It's not going away. It won't be as bad as it is today, but it's still here, and it's not going back to the way it was before. Second point, interest rates are still quite low. They're getting higher, which is creating some pain for people in the markets, but they're getting higher, but they're still quite low by history, and they're not quite high enough yet, unfortunately, which means there might be more pain to come. At the same time, indexes and the equity indexes, so the S&P 500 in particular, is quite expensive today, and that's worrisome, not for the short term, but for the long term. The other points that we think are really important for people to understand is that it's very dangerous to anchor. And so by anchoring, we mean if you have something that was trading at $25 a share and it drops to $10 a share, a lot of people say, well, now it's a bargain. I said, well, that's actually not necessarily true. Maybe it should have never been at $25 a share. So when we anchor to that higher value, we can be misled and we can make mistakes on top of our original mistakes. And then last but not least, and this is the thing I feel like people really don't see, which is that markets tend to change after periods like this. So in the last 15 years, really what you want to do is you want to buy the S&P 500 and do nothing else. It was a beautiful strategy. It worked magnificently. What happens next, given what's going on right now, will probably be different. And so everyone needs to have a more expansive toolkit as they think about investing. Maybe it's value stocks, maybe it's non-US stocks, maybe it's a whole bunch of stuff. And that's where the foundation's diversified strategy really comes into the fore and has a lot of impact. So now let's take you through this S&P point I made a minute ago in a little more detail. The first thing is, I put up this graph for a reason. This is the don't worry about it graph, which is this is a timeline of every really difficult, a lot of difficult things that have happened over the last almost 80 years, 100 years, excuse me. And you can see the S&P 500, which is the line you're looking at, mostly goes up. It's a good story. And the message that people got from this graph, which they should, by the way, get from it, is if you wait long enough, it'll be fine. And I think that's absolutely spot on. The problem, though, is two things. The first is look at the right side of the graph where it goes up and it almost never drops. And if it does drop, it's not for long. And compare that to the rest of the graph, which is very different. There are big time frames where the market goes nowhere or drops for a long time and doesn't recover for a long time. These things in a normal world are what happens. And unfortunately, we haven't repealed normal in this world from this perspective. And therefore, when you look at this graph, people have been misled over this last 15 years to think that the market just sort of keeps going up all the time. It doesn't. And those long periods that you see in the middle are really, really problematic because people do lose their hope and their faith in those times, and we need to make sure we get through those periods. And one of the ways you do that is you acknowledge that this can happen. And if your time horizon is truly 50 years, and that you're really going to stick to your strategy for 50 years, you'll be fine. But if your time horizon is a little shorter, you need to be sensitive to the fact that this doesn't always work out, and that's why you need to be more diversified over time. It's extremely important that we get that message through. So now I want to get a little technical with you because I keep throwing out that the S&P's got a problem, the S&P's got a problem. So let's talk about why we say that. So this graph plots something we call the Shiller ratio. And the Shiller ratio is named for a professor at Yale named Bob Shiller. And he came up with this really good idea, which is we need to figure out a way to measure the value of securities that is not dependent on current conditions. Because the problem is if you're in a booming economy and you look at the earnings of a company, they tend to be higher. And that price to earnings ratio could look lower than it actually is. If you're in a recession that's really deep, the earnings then go down a lot. The price may have fallen a lot, and it could still look very expensive because the E is artificially depressed. So Bob's brilliant insight, it really is brilliant, is let's get away from the cyclicality of the earnings part of the equation and do it in a very easy way. Just take 10 years average, just for inflation along the way, that's your E. And the reason that 10 years works is it's a long period of time, obviously, and you get an economic cycle or two inside of that, which gives you what we would call in our technical world steady state or normalized earnings. And that's really important that we have that number. So now the graph plots for you what the Shiller ratios look like all the way back to the 1800s for the S&P 500. The blue line in the middle of the page is the long-term median or mean that you can see. So when the line is above the mean, that means the stock market's expensive. When it's below the mean, it's cheap by its historic standards. Now, what we're not showing you here on this graph, which is incredibly important, but I want to highlight it right now, is that unfortunately, this graph has amazing information value. When that line is low, the forward returns in the S&P 500 have almost always been high, and when that line is high, they've always been low. So in other words, and it makes sense, think about it in your lives. When you go to buy something at a supermarket, if your dollar goes further, you're happier. If your dollar buys you less, you're less happy. Well, for some reason, investors seem to treat it the opposite way, which is I want to pay more for things. I want to pay more for things. They like high valuations. But the reality is you do get more when you pay less for something. And that's what the S&P has proven out over all these years. So here's the bad news. You can see one of them we've written around in this piece of paper. The S&P currently is 40% above its historic average. That's after the declines we've had this year. So that's a really sobering piece of information. And even worse, when you do the kind of analysis I mentioned before, where you compare the S&P at this level to what its next 10 years returns have looked like historically, unfortunately, the return is about 4% per year, including the dividends. And that is really, really bad, especially if inflation was 3 or 4 and you're trying to preserve the purchasing power of your assets. Only getting 4 from the stock market is not going to do the work. So this is a really important graph. And just to be clear, Shiller ratios have amazing 10-year forecasting abilities. Their ability to forecast the next year is 0. So next year, when I hope to see you all, the fact that the S&P could be up from here will not disprove the Shiller ratio. It's 10 years from now that we'll know what this Shiller ratio actually means. But we're big fans of understanding history, and when it's logical in particular, which this is, you get more for less, less for more, that's a good thing, and we should pay attention. And then the other point I want to make briefly is just related to how we react as investors and how we think. One of the things that the Community Foundation strategy is very much built on is understanding how markets behave and what kind of biases we all as individuals bring into the equation when we do these things and we make our decisions. And we want to be on the other side of human nature. I know that sounds like a funny thing to want to be, but it's one of the ways you get to variant perception and higher returns is you take the other side. And the way to think about that is this. When things look too good, people get a little greedy and you don't want to be there when things change. And when things get really bad and people get very pessimistic, the prices get too low and you want to very much be there. So this graph is a really, I'm sorry, I get really excited about stuff like this, but this is an incredibly cool graph because what it does is it plots 2 asset bubbles, one which occurred about 2 decades ago, which was the NASDAQ 100. So that's, at the time, it was Microsoft and Cisco and companies like that were with the tech darlings in the late 90s. That's the red line you're looking at here. The blue line, and we're not only picking on this because it's readily available information, but the ARK funds are a very prominently known ETF that buys a lot of innovative companies. The ARK funds, by the way, are no worse than any of the other people who've done this kind of stuff, but the reason they're on the graph and no one else is because it's an ETF, so we can see the prices when we put this right on our graph very conveniently. So what you're looking at, which is so amazing, is this. The left-hand side before the dashed line is the bubble forming, essentially, and the ramp up in prices. The period after that is the crash that's occurred since. And what's really interesting about this graph is there's something that statisticians do, which we're not doing, which is use dual scales. And when you use a dual scale, you can make any 2 lines look the same, essentially. In this case, there's no dual scale. It's the same scale. So what that means is on the vertical side, the run-up was almost exactly the same amount of change of value. The crash has been almost exactly the same amount of change in value on the negative side. And really, really interestingly, I know it's hard to read on the screen, but those time periods you see on the horizontal scale, they're the exact same distance between each point. There's no change in point. So what's interesting here is you have the same run-up, the same crash, and it took about the same amount of time, which is just, if you think about it, amazing. And it's a great testament to what I said earlier, which is human nature is one of the few things that do not change. And so when you can take the advantage of that and be on the right side of it as an investor long term, it's really, really powerful stuff. What is not shown on this graph is something I mentioned earlier I want to highlight. Back in 2003 or 2, when that red line was done dropping, it still underperformed for many, many years to follow. And that's the scene of the crime argument, which is that whatever hurt you the most before doesn't necessarily get you back as quickly. So you have to be really careful about what our sphere of information and knowledge is. So here we go. We got a game plan, which is the following. There's a lot of headwinds. There's inflation, there's Federal Reserve policy, there's the potential for a recession that hasn't already started. That are really very significant things and have very significant implications in the short term. Long term, not so much. Recessions do come and go. Monetary policy changes over time. All kinds of things happen. But there are headwinds. And the diversification we have today is actually super important because it helps us get through the difficult periods, but it also positions us for that, again, that scene of the crime point, which is when things get better, they'll be better someplace that people don't expect them to be. And when we're diversified, we will own some of that stuff, and that's really important. The second point recognizing the importance of being a contrarian. Nobody likes to actually be a contrarian when you want to be one, which is to think differently than everybody else, because you kind of feel a little stupid when everyone's just saying turn left and you're turning right. But the reality is that that's a secret sauce of long-term success, and that's one of the ways the foundation's been so successful over these decades. And last but not least, the foundation, because this is a multi-$100-million pool, has access to amazing investors that frankly none of us individually could even find or access, and that makes a huge difference. And it gives us, by the way, a lot of confidence, even in a difficult year like this one, to have 70% of this capital in the stock market, because we know that we have really smart people making really rational decisions, and they're going to add a lot of value. So I thank you for joining me today virtually.